Welcome everyone, this is Dr. Barry Burns with Top Dog Trading, and today I'm going to share with you one of the most popular stock trading strategies that is well known and used by many, and it's a good one. However, today I'm going to show you a little nuance that you need to be careful with. It doesn't always work quite as well as people think, but there's an answer to that, and I'm going to share that with you in this short video. So, the strategy is very simple. Basically, what we're doing is you're looking for a previous high like this, and then you're looking for a breakout. So breaking out of that high means you're going to get a higher high. And what you want accompanied with that in this particular strategy, the way that it's designed, is you want to see volume going with it, good volume. And so here you'll notice when we had this big move up here, we did have an increase in relative volume. And then volume declines a bit. And on this bar here, we get a little bit of extra volume. It's not real significant, but we do get some. We do make a higher high. Now, more significantly though, as we move forward, volume pretty much stays down in here. And then we get this big volume bar. Now, doing the same thing, we're going to look for this high here to be broken. So in this way, sometimes volume can even be a leading indication. I'm not going to say indicator because volume's not an indicator. It's just what is what is. It doesn't indicate anything. It actually measures an actual number, which is how many shares are coming through the market. So this would be an indication that we should break this high and continue with the uptrend, right? So that's the traditional thinking, and many times that is true. And let's see what happens. So the very next bar, yep, indeed, it makes a nice gap up. So if you are following this strategy, the typical way to trade this is to wait for it to break above the previous high. And then when it does, on volume, and we get 2 bars of nice volume here, then you would buy and hope that it continues up. Okay, so let's see what happens. So then after that, the market will, wait a minute, comes down, uh-oh, now it broke even the low. So if you look over here at these lows, it broke below those lows. Not exactly what we wanted, right? We're looking for this thing to buy here and for it to go up. And instead, it actually comes straight down. Comes all the way down to, that's the 50-period simple moving average, that green line. It broke these lows. It really didn't go up at all, other than that one bar, and then it continues to move down even further. So what went wrong? What's the problem? The problem is very simple. It's contextual, meaning that the strategy works when done in the right context or the big picture of the overall chart. So let me show you what I mean. When we look at this, we see that the market has already been moving up for quite a while. So we can call these waves if you'd like to. We've got basically, let me bring up my little arrow here. So we've got to move up, and then this would be your kind of retrace or consolidation. Another move up, retrace consolidation, another move up, another move up. So if you use this just for counting the waves, you'd have 1, 2, 3, 4, 5, 6, 7. And what that means is that is now an extended trend. Counting waves this way, the average wave count is 5, which would be right there. Again, 1, 2, 3, 4, 5. 7 is extended, and therefore that's actually a good place to start potentially looking for reversal trades. Now don't just take them. There's separate rules for when those are high probability. But at the very least, it's the low probability for the trend to continue. Therefore, yes, indeed, we do get high volume on the breakout. But now that volume is to be interpreted differently. That volume is to be interpreted as exhaustion volume rather than continuation volume. So the bottom line rule is very simple. Early in the trend, when we get big volume coming through, bigger volume coming through on the market and breaking these highs, then you have good odds of the market continuing in the direction of the trend. The longer that trend continues, the more likely it is to not be continuation volume, but rather exhaustion volume, showing the exact opposite, showing a high probability end of the trend. So, seeing the big picture, the devil's in the details, things are, the simple rules are nice to have, but simple is good up to a certain point. Then, to become a professional trader, you need to understand the nuances so that you don't get hurt. So, that's the quick lesson for today. If you like this video, please click the like button below and leave a comment telling me what you'd like me to cover in future videos or what you thought of this video. Also, by the way, I'm giving away one of my favorite trade strategies right now. I normally sell this, but you can get it for free. It's called the rubber band trade. It has a very, very high win-loss ratio. It's a very simple strategy. You can learn in about 26 short minutes. So I put it in a video, and you can get that video and that trade strategy by simply clicking the image in the top left corner, or if you're on a mobile device, click the little eye with a circle around it in the top right corner of this video. And once you do that, I'll personally email the video to you with the strategy.